The financial markets are ever-changing. Prices go up and prices go down. Understanding why these movements happen is crucial for any trader. It is not random. These movements are driven by the constant interplay of buying and selling pressure. Large financial institutions, often called smart money, play a significant role in these dynamics. They move substantial volumes of assets. To trade successfully, one must grasp the underlying forces that shape price action. This understanding forms the foundation upon which profitable trading strategies are built. Without it, navigating the markets can feel like sailing without a compass, leaving you exposed to unpredictable currents and tides. Liquidity is a core concept in understanding these market dynamics. In simple terms, liquidity refers to how easily an asset can be bought or sold without causing a significant change in its price. A market with high liquidity has many active buyers and sellers. This means transactions can be executed quickly and efficiently. Think of it like a busy marketplace. Goods are exchanged smoothly. Low liquidity, on the other hand, means fewer participants and potentially wider spreads between buying and selling prices. This can make it harder to enter or exit trades at desired levels. Therefore, liquidity is a vital characteristic of any financial market, influencing every trade. So how does liquidity directly impact price movements that we observe on charts? Prices change due to shifts in the balance of supply and demand. When demand exceeds supply, prices tend to rise. Conversely, when supply outstrips demand, prices tend to fall. Large market participants, when executing their substantial orders, require significant liquidity. They cannot simply place a massive order without affecting the price, unless there are enough counterparties. These large players often target specific price levels where they expect to find sufficient liquidity to fill their orders with minimal slippage. This interaction is a key driver of price action. This brings us to the concept of liquidity zones. These are specific areas on a price chart where a high concentration of buy or sell orders is anticipated to exist. These zones act almost like magnets for price, drawing it towards them. They represent areas where significant trading activity has occurred in the past or is expected to occur. For traders who can identify these zones, they offer valuable insights into potential turning points or areas where price might accelerate. Understanding and utilizing liquidity zones can, therefore, provide a distinct edge in interpreting market behavior and making informed trading decisions. Liquidity zones, in their essence, are specific price ranges on a chart where a significant pool of orders is located. These are not just random levels, they are areas where many traders have placed their orders. These orders can be pending entry orders to initiate new positions, or they can be stop-loss orders designed to limit potential losses on existing trades. When price approaches these zones, the execution of this cluster of orders can cause noticeable reactions in the market. Think of them as reservoirs of buying or selling interest. Understanding their nature is the first step towards incorporating them into a trading plan. These zones are dynamic and reflect the collective psychology of market participants. The orders that form these liquidity pools come from various market participants. Retail traders often place stop-loss orders just above recent swing highs or just below recent swing lows. Similarly, breakout traders might place buy-stop orders above resistance levels or sell-stop orders below support levels. Large institutions are also aware of these common behaviors. They may strategically push prices towards these areas to trigger those stop losses or activate those entry orders. This provides them with the necessary liquidity to fill their own large positions without causing too much adverse price movement for themselves. It is a complex interplay of different motivations and order types. The importance of liquidity zones for a trader cannot be overstated. These zones represent areas where a battle between buyers and sellers is likely to intensify. When price enters a liquidity zone, one of two things often happens. Either the orders within the zone are strong enough to absorb the incoming pressure and cause price to reverse, or the pressure is so immense that it breaks through the zone, often leading to a rapid price movement as the remaining orders are triggered. For astute traders, these zones offer potential opportunities to enter trades with a favorable risk-to-reward ratio, as they provide clear levels for placing stops and defining targets. It is crucial to remember that liquidity zones are not precise, single price lines. They are better conceptualized as areas or ranges. Price might not stop exactly at a predefined line. It could penetrate slightly into the zone, test its boundaries, or even exhibit a false breakout before reversing. This characteristic requires traders to be somewhat flexible in their interpretation and not to expect pinpoint accuracy every time. Viewing them as broader areas of interest rather than exact points helps in managing expectations and setting more realistic entry and stop-loss levels, thereby reducing the chances of being prematurely stopped out of a potentially good trade. Identifying liquidity zones on a price chart is a skill that can be developed with practice and careful observation. One of the most common ways to locate these zones is by looking for previous significant support and resistance levels. Support levels are price areas where buying pressure has historically overcome selling pressure, causing prices to bounce up. Conversely, resistance levels are areas where selling pressure has historically overcome buying pressure, causing prices to turn down. These levels often attract a concentration of orders because traders expect history to repeat, or at least rhyme, making them prime candidates for liquidity accumulation. Another key technique involves identifying swing highs and swing lows. A swing high is a peak in price action before it turns lower, while a swing low is a trough before price turns higher. Orders often accumulate just above significant swing highs, in the form of buy stops for breakouts or sell-side liquidity for large sellers, and just below significant swing lows, sell stops for breakouts or buy-side liquidity. These areas become natural targets for price because triggering these clusters of orders can fuel further movement. The more prominent and tested a swing point is, the more likely it is to hold a significant pool of liquidity, making it a focal point for traders. Consolidation areas, also known as ranges or sideways markets, are also excellent indicators of liquidity zones. When the price of an asset trades within a relatively tight horizontal channel for an extended period, it signifies a balance between buyers and sellers. During this time, orders tend to build up above the range's high and below the range's low. Traders anticipate a breakout, placing stop entry orders to catch the move, while others might place stop losses just outside the range. When price eventually breaks out of such a consolidation, the triggered orders can lead to a strong and sustained directional move, highlighting the trapped liquidity. Finally, traders can use volume analysis to help confirm potential liquidity zones. A significant increase in trading volume when price reaches a certain level can indicate that a large number of transactions are occurring, suggesting a high level of interest and therefore liquidity. Price action itself around these potential zones is also a crucial confirmation tool. Observing how price behaves upon approaching or entering a suspected liquidity zone, whether it shows signs of rejection, absorption, or a swift breakthrough, can provide valuable clues about the strength and nature of the liquidity present. This confluence of factors strengthens the identification process for any trader. Once you have identified potential liquidity zones, the next step is to incorporate them into your trading decisions. A primary strategy involves looking for price reactions at these zones. For instance, if price approaches a known liquidity zone that previously acted as strong support, a trader might look for signs of buying pressure, such as bullish candlestick patterns or a slowing of downward momentum. This could signal a potential bounce and an opportunity to enter a long position. Conversely, a rejection from a resistance-based liquidity zone might offer a short-selling opportunity. The key is to wait for confirmation of the reaction before committing to a trade. It is highly advisable to combine the analysis of liquidity zones with other technical indicators or analytical tools. Relying solely on one method can be risky. For example, you could use moving averages to confirm the prevailing trend. If price approaches a liquidity zone that aligns with a key moving average and the overall trend, the probability of a successful trade increases. Candlestick patterns such as pin bars or engulfing patterns occurring at a liquidity zone can provide strong entry signals. Oscillators like the RSI or MACD can also help identify overbought or oversold conditions near these zones, further refining trade entries and exits. Effective risk management is paramount when trading with liquidity zones, as it is with any trading strategy. Always define your risk before entering a trade. Liquidity zones can help in placing logical stop-loss orders. For example, if entering a long trade based on a bounce from a support liquidity zone, a stop-loss could be placed just below that zone. This ensures that if the zone fails to hold and price breaks through, your potential loss is limited. Similarly, profit targets can often be set by identifying the next significant liquidity zone in the direction of your trade, providing a logical exit point. In summary, mastering liquidity zone trading offers significant benefits. It helps traders understand the underlying market structure and the reasons behind price movements. By identifying these key areas, you can improve your trade entry and exit points, potentially leading to a better risk-reward ratio on your trades. This strategy encourages a patient and observant approach to trading. It requires practice to accurately identify these zones and interpret price action around them. I encourage all aspiring traders to dedicate time to studying charts, practicing the identification of these zones, and observing how price interacts with them. Over time, this can become a powerful tool in your trading arsenal, helping to boost your overall profitability.